Morning. So, yesterday we covered quite a bit of ground. We had several sessions that touched on sort of forward-looking things happening in trade, in payments. We heard from some of our future leaders. Today we're going to hear from leaders in this industry and really try to get into what's on their mind and hopefully provide some thoughts for you all to take away. So maybe I'll just ask them to give a quick introduction. Let's start with Trish.
Good morning, everyone. I'm Trish Sullivan. I'm the head of institutional cash management at Deutsche Bank. I also hold a board observer seat on Partior, which is a blockchain provider company out of Singapore.
And then Vince.
And I'm Vince Hirochi. I am the head of transaction banking at TD Securities. I've been with TD for 25 years, so I'm pretty much a lifer there to my benefit, because I think this is a business which allows you to gather wisdom over time.
Thank you. So we're going to start you off with a poll question. And so we're going to ask you to get your phones out now. And if you can go into the Slido app and answer our poll question. So in your businesses, what are the new business development opportunities that you all are prioritizing over the next, call it 12 to 18 months? We've got digital assets, stable coins, tokenization, new geographies and expansion into new regions, diversification of currencies, fintech partnerships for new products. We didn't leave in other because we wanted to try to channel you into a couple of these topics. So we'll give you some time to continue to answer that. And in the meantime, I want to turn to my panelists. So I can't help but start with the issue of geopolitics. And I noted that this year, for whatever reason, it seems whenever we have a BAFT conference, there's always an event that happens right before it, right? So right before our MENA conference, we decided that, we needed to go visit our colleagues in Venezuela, and that created a certain level of disruption. Moving forward, we then had, I think, our Europe conference in March, and the week before that, we had a couple of things. There was some escalation of tariffs between the US and Europe, and then the US and Israel started to bomb Iran. And so I started to get this feeling that whenever we have a conference, something happens, right? And of course, yesterday, the ceasefire sort of came apart. And so the good news is we only have one more conference left soon next week, and then we'll take a break. So hopefully the world will stabilize a bit. But so, if I think back about geopolitical impact, and we can go back to the Russia war, obviously from where you sit, it's massively disruptive. And so without getting into the specific impacts of each of these things, tell us a little bit about how that has shaped the way you've approached risk management in your organization and planning for resiliency and just how are you addressing disruption, and are you doing anything new or different than you have? Trish, maybe I'll start with you.
I think first I would like to say I no longer think of these risk issues as events or periodic episodes. It's now just absolutely embedded. So whether there's a conference or there's no conference, I think every day we're all facing new risk challenges. So as part of that new embedded approach to risk management, one thing we're definitely doing differently is we've 100% embedded in our first line team, a risk management team. So reporting directly to me, we have a team of almost 100 people that all they do all day long is help respond to risk events and work with our second line colleagues to do that. And we found that to be really beneficial for our clients in terms of not only providing real-time advice on how to manage emerging tariffs, new sanctions, shifting corridors as money and collateral moves to safer channels. But also it's helped us manage how we look at our data. So I'll give you an example. When going back a year already, when the tariffs were first launched on Liberation Day, we were able to do quick data analysis using some AI capabilities to help understand which clients might be most impacted by the tariffs. So looking at these episodes as embedded risk and then applying a deep risk management team around it, as well as better data analytics capability in our team, we find we're better able to respond in real time.
Yeah. Vince, anything new that you all are doing differently?
Well, I think we're living in the age of the prominence of geopolitical risk, and I think we need to be careful with that term. Geopolitical risk seems to be this like remainder bucket that everyone throws every issue in that they're somehow not familiar with or in some way could be a surprise. So I think the lesson to learn here, I think by the time people start shooting at each other in Iran or Ukraine or wherever, that's just a symptom of what's been brewing for a very long time. And I think that as banks, the funnel through which we produce risk management people is credit risk. And that's a very narrow view of the world of risk. And as the world becomes increasingly volatile, I think that we need to advocate for risk management approaches and risk management staffing and risk management training that can encompass a broader view of the risks that we face in the world. Because what we're seeing now is really just an expression, the conflicts that we're referencing here, just really an expression of a lot of tensions in the world that I see only getting to be more serious and more challenging. And I think us in the room here in transaction banking have a particular obligation to advocate for this because we sit at the intersection, we facilitate international stuff, whether it's trade, whether it's payments, but we are the connectivity between different countries, and that's the friction point where geopolitics really starts to have the primary impact. And so if we want to be able to run our businesses, we need to have risk management groups that can accommodate those types of and understand those types of risks. I think that's a lesson that's the big lesson that we learned.
Yeah.
And I wouldn't even say we've learned it. Like that's the big lesson I've learned, but I think the rest of the bank needs some schooling. So, and it's probably the case in all of your institutions.
Yeah. So, of course, I think the most extreme example is you close the Strait of Hormuz. Obviously, that's got a direct impact on flows of commodities. But even before then, if you go back to tariffs, even before then, you go back to U.S.-China trade wars, and there's been a variety of events, that have caused transaction flows to shift, companies to rethink their supply chains, rethink how they mitigate dependence on concentration risk with certain partners in certain regions. So there's been a lot of disruption on top of the what I'll call the organic disruption in your business coming from new technologies and so forth. Of all of these shifting patterns, which of these do you think are going to be most lasting and most impactful in the long term? And which of these do you think will be more cyclical and will sort of swing back into some semblance of normalcy? Vince, maybe I'll start with you with that.
Yeah, thanks. That is a really tough question. And I think we also have to define what's long term. I think that if we consider it, our working lives, that's like if we consider it generationally. So for this generation of bankers, what is going to be their primary concern? That's how I think of long term. I think that geopolitics is omnipresent, but there's a level of intensity that we haven't experienced before. But if we look along a broader historical timeline, there's nothing new here. And so we kind of know how to deal with it because humans have been dealing with it for hundreds of years. What is very new and which we don't really know how to deal with is the technology, and especially AI. I mean, it's, if you go to any of these conferences, it's AI is every second word that gets spoken about, and that's because there is so much fogginess and uncertainty about how this is going to impact so many different areas of what it is that we're doing. And it's something very different in terms of previous technological advancements that I don't think we have a clear vision for the very, very long list of areas where it's going to impact. So I think that is a very new thing that we're very ill-equipped to deal with and forecast its impact. And I think that's going to have the predominant driver of what we in transaction banking do for the rest of our working generation here.
Yeah. Trish, any additional thoughts?
No, I 100% agree with Vince, and I think it's really important that we as leaders in this room help senior management prioritize where the focus needs to be so that we make sure the investment, whether in a 3 to 5 year strategy, gets directed in the right places. I do think geopolitical shifts are perennial, so we just respond in real time, and that's not going to change. But if we don't really help prioritize our digital asset strategy, I'm not surprised to see that it's number 2 here, because investing in your digital asset strategy isn't going to bring you quick money, and everyone needs to focus on meeting their revenue targets. So I'm not surprised people are putting number 1 as expanding into new segments or geographical regions. But when I think about prioritizing for senior management and getting investment where it needs to be, we are definitely focusing on where we want to be as a bank in terms of digital assets, what our infrastructure needs to look like, and making sure we get the right investment so that we build our own infrastructure, but also partner with the right groups in order to really have the proper ecosystem to deliver a full digital asset strategy. But beyond that also is making sure that we don't lose sight of the enablers, such as really high data quality that's going to enable strong compliance, as well as having the most efficient use of AI. So you have to do a lot of things at once, but make sure you focus on where the long-term money needs to be invested so that the budget is ready.
Yeah.
So, sorry.
That's a great point. Because the results went down there, but I noticed that the last one, the one which was least popular, was the issue of partnership with fintechs. I think if you ask that question strictly to people tasked with making capital investment decisions, you may have gotten different results. And because when we have a situation where globally there's so much uncertainty, there's a long list of factors, everyone talked about them all yesterday. It makes it really difficult to make investment decisions. Like, if I invest in product A, will product A be around long enough to generate a positive return on that investment? Will the product A be superseded by digital assets? Should I be redirecting my capital into digital assets? And digital assets is just one example of a disruptive technology that we have to contemplate investing in. So the solution to some of this is, in my mind, partnerships with fintechs. And that is, if you want, just like in your personal portfolio, like if you have an investment portfolio, the way you mitigate risk is through diversification, right? You hold a broad portfolio, a whole bunch of different shares and other instruments, so that the risk is spread and no particular risk can basically sink you. And I think if we went through our CFA stuff, you could calculate the risk and all that. Mm-hmm. Similarly, there are mechanisms in the free market to syndicate risk across a broader cross-section of counterparties. And those are the fintechs. The fintechs have an actual place in our ecosystem because they, by having capital which is much more favorably disposed to taking risk and having a broad cross-section of clients and potential clients, they're equipped to take risk that we as a bank only are bearing a little piece of. And so rather than having to develop the capability in-house where I assume 100% of the risk, I can allocate a much smaller number to potentially partner with a fintech and have them bear the risk. And if I spread that out across my portfolio, I think the trick to the investment is figuring out which ones are essential to be done in-house and which ones where you can actually syndicate the risk of development.
So I'm going to sort of show my Americanism here because having lived here for so long, we're kind of raised with this love for American exceptionalism, right? And I think the nerd in me thinks that the dominance of U.S. dollar as sort of the world's currency has afforded us a certain position in the world. This, again, is just my theory, not the BAFT theory. But what I've seen over the last couple of years is challenges to that thesis, right? 2 years ago, I think we were here, we talked quite a bit about de-dollarization. We talked quite a bit about BRICS, what the future of BRICS might be. And so I was just looking at a couple of stats. Since 2023, non-US dollar stablecoin transfer volume has increased by 1,600%. Still a small base, but that's a sizable percentage change. Payment volumes going through SIPs, or the Chinese payment system, has grown since 2023 by 27% in value, 50% in volume. And China's trade, if you just look at parties trading with China, the percentage of that trade that settled in RMB has gone from 24% in 2023 to 54% last year. So I wanna revisit the question of optionality. And we've talked quite a bit about new payment channels. We can't ignore the fact that whether it's digital assets or whether it's other currencies, that optionality to US dollar dependence is a real thing. So I'm interested just in your perspective, how do you think this is gonna play out over the next 3 to 5 years? Trish, maybe I'll start with you.
I mean, no doubt, globally, the pie has grown significantly larger for global payments, regional payments, domestic payments. So there's just more payments flowing. But also, the volume of dollar payments has also gone up. So as the pie has grown larger, there definitely has been also an explosion in the SIPS network and in other regional networks that are not moving in dollar, and that's fantastic to see that consumers and have more options for how they're making their payments on a regional basis, on a domestic basis. But the dollar still remains dominant. We're also seeing a drop in reserves being held in dollar, more moving into gold and even in euro. But it's still going to take some time before the dollar loses that dominance. And to me, what it means is, as a bank, we just have to be able to offer our clients different optionality so that they can take advantage of what makes most sense for their clients in different settings. With the tariffs, with different sanctions that have emerged, it has been advantageous for clients to have different options to move value regionally outside of dollar, shift to different corridors, and we want to make sure that we can provide the rails that allow those different options and the connectivity so we can act as the on and the off ramp. And it's beyond just fiat payments, right? Also, we're seeing more flows coming in stablecoin. And how do we make sure that we're equipped to provide our clients with the on and the off ramp for those types of flows as well? So to me, it's a really good development that people have more options, but the dollar still remains dominant, and I would say at least 10 years.
Optionality is an opportunity more than a threat.
Mm-hmm.
Yeah,
absolutely.
Vince,
Yeah, no, I agree with that. Let's extend that. So my personal opinion only, is that the ultimate guarantor of the U.S. dollar is not the Fed; it's actually the U.S. Navy, and that is because the U.S. Navy is what secures trade routes around the world and allows all these goods to move around. And to the extent we enter into a trend where the U.S. loses its soft power influence or even its hard power ability to enforce through threat of arms its rules of trade, that is what it's going to take for the U.S. dollar to people to suffer a lack of confidence in the U.S. dollar. 10 years, it's going to be at least 10 years. The U.S. is such a predominant military force able to impose its will upon the rest of the world that's not going to change for a very long time. But at the same time, what's happening in the background is this, if you want to think about this, and I'll continue with a military analogy, an insurgency against US dollar dominance, and that is when we implement stablecoin tokenized deposits, everything which increases people's confidence in the utility of a digital distributed ledger, I think we might get through a back door back to those kind of cryptocurrencies where the US dollar might not be involved, where you may have, once people become comfortable with a digital ledger, then that opens the door to, well, why do we need to have a digital ledger which is somehow affiliated with the US dollar? Can we have a digital ledger which is somehow affiliated with some kind of third-party non-US dollar, i.e. Bitcoin would be one example, but there's many others, right? I don't think you're going to get there where they see the need for that until they have serious questions about the dominance of the US dollar, and I don't think you're going to get to that until we see a change in the military balance around the world that affects that really alters trade flows.
So Vince, I'm going to stay with you. I want to go back to a word that you used a little bit earlier, which was investment. So you all both had very large businesses that had brought in diverse institutions. Tell us a little bit about, where you think the industry collectively needs to make more investments, and what is it that you think we should be prioritizing? Not just on an individual bank, because obviously every individual bank has their priorities, but collectively.
My turn?
Yeah.
So it goes back to what I said before, which is as one of the people who's involved in making decisions about capital allocation for product development, there is far, far more product that needs to be developed than we have money to pay for it. And I'm not alone. Everyone in this room who has to face that decision has the exact same problem. And so as an industry, it would be to all of our mutual benefit if we could share the cost of that development. I know that sounds crazy in a world where we're supposed to be all competing against each other, but there's mechanisms for that to happen. There's mechanisms through the fintech ecosystem. There's mechanisms that we're seeing through digital assets, through some of the consortiums that are arising where the cost of development is being shared between banks. But I think we're going in a direction where we really aren't going to have a choice, where it's going to be, unless you are one of the leading global institutions with a massive technology budget, every other bank is going to be faced with the challenge of how do I compete against that with a much more limited investment budget just by virtue of my size. So cooperation is really going to have to be the salvation here to share some of the cost of developing the new technologies that we're all going to need, in my opinion.
I think we haven't made enough progress in using utilities to streamline risk management. I think as profit margins compress, it's really becoming difficult for banks to manage the cost of maintaining these super complex risk management systems, and each bank doing it separately. When I think about some of the utilities that are building around blockchain infrastructure, there's really an option there to embed risk management into that technology so that all of the participants can use it and not build siloed risk management platforms at their own banks. So I'd love to see more development in that space, and that's something we're absolutely advocating for. But even within your own bank, really putting in the investment to streamline risk management, the focus on AI. There's so much potential to bring down the costs and still have highly effective outcomes.
So I want to drill down on this investment question just a little bit, specifically as it relates to trade, and either one of you can take this. And so within the trade space, we talk about a couple of things. We talk about how slow the pace of digitalization is moving within trade. And we also talk about this stubborn and resistant trade finance gap. And there seems to be a common belief that, well, if we could finally digitize trade, we'll solve this trade finance gap problem. Are we crazy? And will that really be the key, do you think, to unlock access to capital for a lot of firms that can't get it?
I'll start. I mean, trade is such a beast because there's just so many different participants in the ecosystem and different legal frameworks you're operating in around the world. So I think while there has been some good developments in digitizing trade, it's really hard to get all the small players, fully digitized. So there's still a lot more work to be done, but it has good potential, and I also think to embed risk management if it really was fully digitized. But also I think more focus needs to be on streamlining and having consistency around the infrastructure for trade in terms of legal frameworks, data infrastructure. There's been so much more progress on the payment side in terms of building that type of global consistency that we just haven't seen as much on the trade side.
Yeah, I completely agree. I think like the holy grail in payment space is straight through processing, and we've made such progress on automating that, and it hasn't been the same with trade. I think we might be able to skip a few steps here because of the advent of AI, and that is you don't need to have a perfect alignment data between counterparties where their data aligns perfectly and falls into the defined fields when you can overlay AI, which will do all that stuff for you. And I'll just share an example. I was in the market to buy a house, and I wanted to build a comp table. All I had was a crappy PDF from my agent that listed 1 million houses that had sold recently. And I just put that thing, that's a pretty unclean source of data. I just put that thing into AI. I uploaded into one of the AI chatbots. I said, make me a comp table, and 30 seconds later, I had a perfect comp table. I iterated on it for 5 minutes to get the columns the way I wanted and define factors. But like for it to be able to do that, it was like a real life demonstration of the fact that a lot of the issues we have with lack of systemization, standardization, documentary differences, unique regulatory requirements for each jurisdiction, like a lot of that can be dealt with now in a much more automated fashion with an AI overlay. So I'm actually really optimistic that trade will catch up with where we are in payments. And yes, to answer your ultimate question, it's not going to solve the problem of the trade gap, but it certainly can't hurt to make the process as efficient as possible and bring down that cost, the cost that all of us bear to administering this system. If we can bring that cost down, it's going to lower the cost of financing for everyone. Maybe we need a bit more capital behind this, but behind the actual provision of capital and liquidity to our clients. But I think it would really move the needle. Might not solve the problem.
Okay, so we've covered geopolitics. We've talked about trying to future-proof the business relative to the volatility and flows. We've talked about the opportunity of optionality. We've talked about how to prioritize investments collectively as an industry. Touched a little bit on trade. What have we missed? Are there other business model issues that you think everyone here ought to be having conversations about within their institution to really prepare for the next iteration of what we're going to face in transaction banking? Vince, let me start with you, and then I'll come back to you, Trish.
Sure. I think the biggest problem, I really feel for the young people right now. And I think everyone says that, it's so difficult to get started in the industry as a young person, in any industry now, because there's many fewer positions open for people who are starting off, people who are right out of school or very junior in their career. That's going to come back to bite all of us. That's just not a young person problem. That's all of our problems, because we're going to have this big gap between people who have the experience and wisdom, like I referenced when I started, having been in the industry for so long, and then a much smaller cohort behind them that may not have the scale to inherit all the machinery that we've created. And so my big concern is about succession and continuity of this and all businesses, given the fact that we expect to completely eliminate a lot of the junior tasks through the application of AI. So, I mean, we talk about how AI is a huge opportunity, but I think this is where AI could be a huge threat to the industry.
Yeah, it's funny, last night at dinner, we were talking about something very similar to this, and someone at the table said, well, AI is just, like the latest technology development, and, have we all become our parents now where we're saying, what's going to happen to the young generation? And I was thinking about that because, I mean, I think this young generation, they're super smart, they're super adaptable, and I'm not so worried that this is going to just fundamentally change, how people have jobs, and I think there'll be lots of adaptations and more opportunities. But one thing I do think we need to do more of in terms of focusing is organizing our banking structures around client ecosystems, and not being so, all of us in this room spend a lot of time on product, but really thinking about how our clients are operating in their ecosystems and organizing better around that. And that's something that I think takes a lot of work and a lot of re-engineering in terms of how banks are set up. But when you think about the client experience, that would really be value add to try and put ourselves together as a service provider to match their ecosystems and not be so siloed around products.
I see we have two questions here that are somewhat related. And either one of you, if you'd like to take a swing at these, how do you make decisions around build versus buy versus partner, working with fintechs and deploying your own resources?
I think we have the short answer is I just go ask my head of product, Chris Chazen, to make him decide. But sometimes when I get involved in these decisions, we want to not build. Like, building is expensive. Banks are not necessarily designed for building technology, but when there are unique characteristics that cannot be satisfied through a product which is available out in the market, you're left with no choice but to build. And some systems are so well established, or some systems are so broadly applied across the bank that we can't change them. We need to live with them, and we need to build something over top of them that allows us to do what it is that we have to do. But to the extent there are things available in the market, you've made a very good assessment of what's available in the market. To the extent they can do your stuff for you, there's no need to build. And in fact, my experience is that building is a much less efficient approach.
I'd like to see, can we bring up the poll results from the Slido question? I recognize we're almost out of time, so I want to ask you all sort of the final question, if you will, and it's got two parts. This is not the Slido results that we had. But going back to the original question, which was which business development opportunities are you prioritizing? Digital assets, stable coins, tokenization, there we go, that one. So it's kind of a two-part question. First is scale of 1 to 10, 10 being the highest. What's your level of optimism for the future of this business? And how would you answer that question? Trish, maybe we'll start with you.
So for the future of financial services?
Transaction banking.
For transaction banking, 9, really high. Go back, centuries and centuries, there's been trade and movement of value, and that's going to continue. And how would we prioritize resources? So I try and think short, mid and long term. So definitely long term, we are prioritizing getting the right investment, whether it be through partners or our own build, into making sure we have the right options for our clients in terms of a multi-rail framework, right? Clients want options. Fiat's not going away, but there are other things building, and we want to be able to be that on and off ramp across multiple rails. That's part of the long term. In the immediate term, we are super invested in deploying AI over risk management, over data enhancements. And that's how we speak to senior management to get the right budgets in place.
Thank you. Vince,
Yeah.
scale of optimism, 1 to 10.
I agree with Trish. It's off the charts, and that's because we own the pipes. Nothing in the financial banking industry moves without our involvement. And as we've discussed for the past half hour, it's becoming more and more difficult at all those intersections, of various centers of power around the world to do what we do. And so I think that we will become even more essential than we are now to help our institutions, for them to do ECM and DCM and lending, all those other things, for them to do all those things. They're going to have to really, we will really have to step up and do our job in a much more challenging environment of being able to route those pipes in the right places all over the world.
Well, look, the clock has struck 0 and Cinderella has lost her slipper. But I want to sincerely thank both of you for sharing in this discussion this morning, which hopefully will leave some food for thought and for people to talk about later throughout the day. Thank you very much.
Thank
Thanks.
you, Todd.